Hello. Today I'm going to show you how to do a poor man's covered call. I'm going to use Microsoft Corporation, ticker MSFT. And the way I came up with this trade is using the scan tab. I scanned for high volatility stocks. Microsoft was in that list with quite a bit of front month volatility. So I figured I would show you how to do this. What I've done is crafted a poor man's covered call using an out of the money January 2016 $40 call long, and then a short or front month, well, a short and front month $37 call for a trade that amounts to $2.27 with $300 in additional margin requirement. So about $527, maybe $530 of capital required for this trade. However, let me show you the trades individually, and it'll make a little more sense. So what I'm going to do is buy the long $40 January 16 at approximately $3.40, and then subtract from that the short January 14 at approximately $1.13, which nets obviously $2.27. Now the question would be, how do you roll this? And what you want to do is roll this one month out and one strike up each month, approximately 4 to 10 days before the option expiration on the short month. And to get a good idea of what you might make every month, the easiest way to do that is to take the month you're going to sell, which is January 14 in this instance at $37 strike. And then what I do is I look at the December, which is only 7 days out. That's why we're not going to buy it. But it gives you an idea of what the roll might be. So it's $1.15 minus 50 cents. So about 60 cents, maybe 65 cents, depending on the volatility. And it could be lower, obviously, if the volatility is very low. But if you were to make about 60 cents a month, that's $60 a month on one trade, or 11% on return on investment, including the margin risk, and then multiply that by 12, and you're making at least double your money, probably 130% on your money. However, things could change. Obviously, this is a 2-year trade, so you want to do it on a solid stock like Microsoft or an ETF. But as the months go out, the margin may lower, and you could end up making more money on the directional portion of this as well. But the real interest in this is the 60 cents a month, and your capital investment, your net capital investment, is $227 with an additional $300 in margin. So that's just a poor man's covered call. I do it a little differently in that I do an out of the money call to lower the cost on the front end and the risk. So instead of doing an in the money call, which might normally be done, I do an out of the money call, which just saves a little money on the front end. Your risk is roughly the same, and you're really doing this for the theta each month. So if you have any questions, you can always visit our website, www.selltheta.com. And then if you want to visit us on Twitter, our Twitter address is www.twitter.com/selltheta. And then you can also visit us on Facebook at www.facebook.com/selltheta. Thank you and have a good day.